Hello friends, welcome back. Today we are discussing about annual profit plan and supporting schedules. In the previous sessions, we covered about different budgeting methodologies like zero-based budgeting, activity-based budgeting, bottom-up budgeting, top-down budgeting, different budgeting methods. Once the organization developed a budget, it cannot achieve its objectives alone with that budget. There has to be supporting schedules and the exact procedure to implement that budget and to monitor the progress and controlling activities. Organization cannot achieve their objectives simply by setting goals. They must develop a detailed plan that translates this goal into measurable actions and financial targets. An annual profit plan, referred to as the master budget, represent the organization comprehensive financial goal and operational blueprint for a future period. Again, budgeting is merely a financial exercise performed once a year. We know budgeting is not a one-time process. It is a continuous process, and once you implement the budget, there has to be a proper tracking system to track the progress towards the budget. Also, controlling activities. That means, is there any deviation between the actual and the budgeted? There should be a proper controlling procedure to rectify that variances. Let's move into budgeting cycle. Budgeting cycle is a continuous process that extends throughout the fiscal year. Although the annual budget is usually finalized before start of the year. Normally we know that annual budget is finalized before the start of every year, and the budgeting activities has to be continued as the manager monitor performance and prepare future period. Once you finalize the budget, still the budgeting process is not completed. There should be a proper periodic review and controlling activities, proper control system to help the companies to progress toward their goals. Budgeting cycle typically involves four major activities. The first budgeting cycle, the first activity is planning future operations. Before developing a budget, the managers has to plan their future operation or their future plan, which include historical performance data, current business conditions, and future expectations has to be analyzed to create realistic forecast and operations plans. Then the second activity is measuring actual performance. Once you set a budget based on your planning, there should be an actual performance. Though this actual performance has to be measured, and the actual performance has to be compared against the standard to see is there any variances. These things can happen month basis, quarterly or half year or even yearly as well. Then the fourth process, that is investigating variances. Suppose you measure the actual performance and you identify there is a variance in this improvement or in the process. So what you have to do, you have to investigate that variances and you have to take the corrective action to rectify that variances, because we don't have to happen that variances in future as well. Then the fourth process, that is continuous planning. Again, once you set a budget, your planning is not going to end. Planning is a continuous process because the business environment is changing rapidly, like the market conditions, customer preferences, competitors' activities, economic development, everything happening day-to-day basis. So your planning has to be continued for throughout the year or throughout the period, and this planning result has to be incorporated into your budget to set your budget as realistic as possible. This continuous planning helps the business to not only to improve the current performance, but also to enhance future budget and strategic plans. So these are the 4 activities involved in a budgeting cycle. The first one is planning future operations. Second thing is measuring actual performance. Third thing is investigating variances. And fourth one is continuous planning. Now, let's move into next concept, that is management participation in the budgeting. What is a management or board level or top level management role in the budgeting? We know that successful budgeting requires the participation from all level of management, whether it is from top level, middle level or lower level. While, what is the senior executive role? Their role is to establish overall strategic direction. And lower level managers contribute their operational knowledge that improve the accuracy and practicability of the budgeted estimates. So it's a group activities where the top level management set the strategic objectives and the middle level or lower level management contribute their operational knowledge towards that help to improve the accuracy of the budget figures. Now, what are the top management objectives or their roles in the budgeting process? First role is establishing organizational goals. They have to establish the organizational goals before starting the budgeting. Then the second role, communicating priorities throughout the company. They are the one who set the priorities in the company, and they have to communicate their priorities into all level of the organization. Then they have to provide guidance and support to budget preparation process, and they are responsible for reviewing and approving budget proposals. And finally, their responsibility include monitoring overall performance. This is top management responsibility in the budgeting process. Let's move to next concept, that is participative and bottom-up budgeting. We know this. Participative budgeting is the budgeting method where the lower level managers or lower level employees also participating in the budget preparation process. They are also part of the budget preparation process. So the participative budgeting helps the management to communicate their budget expectation clearly, because they also, even in the lower level management, also participated while preparing this budget. The participative budgeting has several advantages, like greater employee commitment, because employee will commit more to the budget because they also participated in the budget preparation process. Then the increased acceptance of organizational goals, improved communication across departments, more accurate estimate due to operational expertise, because lower level management has more expertise knowledge in the daily operations, so which will help the management to improve the accuracy of their numbers. Then higher motivation to achieve planned result, because once you participate your lower level employee in the budget, they think that this is our budget, and there will be higher motivation to achieve the planned result. Then bottom-up budgeting. Bottom-up budgeting is a similar concept to participative budgeting, but here budget process begin with the operational level from the bottom level and it's moved to organizational hierarchy. Like revenue projection, resource requirement, cost estimates are initially prepared by operating unit or the lower level units, and it is consolidated and it is sent to higher level management to approve the budget. Even which method, suppose the participative budget or the bottom-up budget, if you use any of these methods, still the senior level management remain responsible for strategic direction and establishing priorities and ensuring consistency throughout the organization. Even if you use any of your budgeting methods, like even participative or bottom-up, still the setting the strategic direction and establishing priorities are the responsibility of top management. Now let's move into development of master budget. The final output of annual planning process is the master budget. It consists of a complete set of projected financial statement including budgeted income statement, budgeted balance sheet and budgeted statement of cash flow. Master budget is the set of budget which include a complete set of budget which include your budgeted income statement for a particular period, budgeted balance sheet and budgeted statement of cash flow. Again, individual department budget are prepared for responsibility centers and then it has to be consolidated into the master budget. Then master budget can be divided into two key categories: operating budget and financial budget. Operating budget this is the budget related to your operations like your sales budget, production budget, direct material usage budget, purchase budget, direct labor budgets. All these are related to business operations. Then the financial budget include budgeted income statement, budgeted statement of cash flow, budgeted balance sheet. These are the part of financial budget. So let's move into operating budget. Operating budget focus on organization revenue generating and production activities. It supports the preparation of budgeted income statement and includes several interrelated schedules. Operating budget includes sales budget, production budget, material usage budget, purchase budget, labor budget, your overhead budget, ending inventory budget, cost of goods sold and non-manufacturing expenses budget as well. This is the foundation of financial budget. Once you prepare the operational budget, then you can use the figures or the data from the operational budget to generate your financial budget. Then the financial budget. Financial budget focus on cash management, financial requirement, investment and financial positions. The primary component of financial budget include first one capital expenditure budget, then cash budget, budgeted balance sheet and budgeted statement of cash flow, then budgeted income statement as well. Then capital expenditure budget. Capital expenditure budget include what is capital expenditure? It is include or what we call as capex. It involves acquisition, construction of long-term asset such as building, machinery, equipment, technology system and other productive resources. Again, because this investment requires substantial financial commitment, this has to be planned properly because once you have a capex, it requires substantial or very high financial commitment. So this has to be planned in advance. Normally, organizations prepare their capital expenditure plan or capex budget several years ahead to plan properly. Capital expenditure budget identify approved investment projects, planned expenditure on each project, timing of expected cash outflow, timing of anticipated cash inflow and the financing requirement for each project. Then the capital budgeting impact or affect the several components of your master budget. First thing, it has an impact on the balance sheet. Once you have a capital asset or capital investment, it will impact your long-term asset value in the balance sheet. And the impact of income statement. If you have more project or whether it is generating additional revenue, it has an impact in your income statement and the related expenses as well, like the depreciation or financing expenses also impacting in the income statement. Then your impact in the cash flow statement. We know that there will be a cash outflow and later stage in cash inflow also from a capital budget or capital capex. So this capital expenditure will affect in the statement of cash flow as well, because capex include cash outflow and cash inflow. Now let's move into preparation of operating budget. What is operating budget? Operating budget it is the budget related to day-to-day activities or operations of a business. Operating budget must be prepared in a logical sequence because many schedules depending upon on information developed at earlier stage. Normally the operating budget or the budget preparation process starting with the sales budget. Based on the sales budget, you can develop your production budget, your purchase budget, your other overhead expense budget, marketing expense budget, and finally you can prepare the projected income statement, projected cash flow statement, and projected balance sheet as well. So the budget preparation process should start from the sales budget. What is a sales budget? Sales budget is an estimate quantity of a product expected to sold and the expected revenue from those sales. This is the expected sales or expected quantity of product to be sold plus the expected revenue. The sales revenue should be based on the sales forecast, strategic objectives, market condition has to be considered, your production capacity has to be considered, and your historical performance. Sales budget serve as the foundation of all remaining operating budgets. Once you develop your sales budget, based on that you can develop your production budget, your procurement or purchase budget, your warehouse expenses, overhead expenses, your sales and marketing expenses. All other expenses, operating expenses should be based on the sales budget. Suppose if the sales expected to increase, there should be additional production, labor, material, and support resources will be required. So based on the sales budget, the other budget can be developed. Now, what is an importance of accurate sales forecasting? Just we discussed. All other budget is depending on the sales budget, whether it is your production budget, your purchase budget, your sales support budget, your other operating expense budget has to be based on the sales budget. So the sales forecasting should be accurate as much as possible. Suppose if the forecasts are excessively optimistic, that means you will plan your production based on that and your inventory level will increase and your storage cost may rise and there will be a chance for cash shortage as well if your forecasts are excessively optimistic. Again, if your forecasts are overly conservative, what will be the impact? Your production may not be sufficient and inventory short can happen and customer orders can lose. Again, the sales forecast is one of the most difficult forecasts in the forecasting process or in the budgeting process because sales has to be forecasted based on your intelligence or based on your forecast, based on your previous history, based on the market expectation. This has to be forecasted and all other schedules like your production budget or purchase, warehouse and other supporting budget has to be developed based on the sales budget. So the sales budget is the foundation of all other budget. So this is the most difficult budget in the operating budget. Again, there are a lot of factors which is affecting the sales budget, which is beyond management control, like the economic conditions, competitors' plan, customers' preferences, technological development. These all factors are affecting the sales budget, and the important thing is most of these factors are beyond the management control. Again, you have to consider your production capacity as well. Once you developing a budget, you cannot plan your sales more than your production capacity. Now let's move to production budget. Once you have a proper sales budget, you can plan your production based on that. Production budget depending on what is your expected sales volume for a particular period, and what is your expected or desired ending inventory, and what is your desired or expected beginning inventory. So how you calculate the unit to be produced? First thing, your budgeted sales plus your desired ending inventory, then you can minus your beginning inventory. Suppose a company expected to sales 10,000 unit of a particular product, and the company want to keep another 2,000 unit in the ending inventory, and the beginning inventory, there will be 1,000 pieces or 1,000 unit of beginning inventory. So in this case, how much quantity you have to produce? You have to produce your expected sales volume plus your desired ending inventory minus your beginning inventory. So in this case, it is 11,000 unit should be your production quantity. Once you have a sales forecast and desired ending inventory and the beginning inventory, you can easily convert that into your production budget or production volume. So that production volume you can use for your budgeting process. Then the inventory objective. Suppose the management want to increase the inventory, the production must exceed the expected sales volume. Again, if the management want to reduce the inventory, then production can be reduced than expected sales. Then the production timing. We know that production timing also has an important fact or impact in the overall cost of an organization, because once you produce more quantity and planning to keep that quantity for too long, it will increase your storage capacity or storage cost and your working capital cost as well. Now we are moving to direct material usage budget. So we started with the sales budgeting, then we came to production budget, now direct material usage. Then how you will calculate the direct material usage? You have to take your production budget or the production quantity, and you have to apply the bill of material and standard material cost to your production budget. What is a bill of material? Bill of material is a list of material or list of material to produce a particular unit of product. Suppose you plan to produce 11,000 unit for a particular period. The bill of material means the list of all raw material plus your cost, expected cost to produce that 11,000 units. A bill of material identify first one, material required for each product and the quantities needed, production sequences and processing requirement. Again, the amount of material required depend on the production volume, manufacturing efficiency and the material qualities. Now we understand what is our material requirement. Now we are moving into direct material purchase budget. Once you identify your material requirement, you can start your material or you can prepare your direct material purchase budget. Again, direct material purchase budget formula is material needed for the production plus desired ending inventory of raw material minus beginning inventory of raw material. Suppose we need a 50,000 pieces or 50,000 unit of raw material to complete a production, plus you want to keep another 10,000 as your ending inventory, then minus if you already have a 5,000 as your ending inventory, beginning inventory, that you can reduce. So this is the material required for the production, and 10,000 is your desired ending inventory minus you can decide your expected beginning inventory. So in this case it is 55,000 unit is your direct material purchase budget. Now let's move into direct labor budget. What is direct labor budget? It is an estimate of direct labor hours and direct labor cost required to meet planned production levels. You have a planned production level and your direct labor budget tell you what is your expected direct labor hours and what is your total direct labor cost to meet their planned production level. So how you will calculate this total direct labor cost? Your standard labor hour per unit. Suppose you are planning to produce 50,000 unit and your standard labor per hour unit is 1 and your standard labor rate is $10 suppose. So in this case how you can calculate your direct labor cost? It is 50,000 into 1 into 50 or into 10. So into 10 it is 500,000. Again direct labor cost include not only wages. Suppose we are thinking that the direct labor cost is only labor, actually it is not only labor, which include the payroll taxes, social security contributions, workers compensation insurance, health insurance, pension contributions and all other employee benefits. Then let's move to manufacturing overhead budget. What is manufacturing overhead? Manufacturing overhead are the expenses or overhead which is included all production related costs and cannot be directly traced to an individual product. These are the manufacturing overhead. What are the examples of manufacturing overhead? Like your depreciation, factory supervision, your rent, electricity, all these are manufacturing overheads. So the manufacturing overhead you can divide into two. First one is fixed manufacturing overhead and variable manufacturing overhead. Fixed manufacturing overhead include your monthly depreciation or your periodic depreciation, factory supervision charge and facility related expenses or all other facility related expenses. This cost, fixed costs remain same constant within relevant operating range. Whether you produce more or less, your fixed manufacturing overhead will remain same. Now let's move to variable manufacturing overhead. Variable manufacturing overhead are those overhead which vary or which change based on your production levels. Like your indirect labor, indirect material, equipment maintenance, factory supplies, all these are variable manufacturing overhead which vary based on the production level. So how you will calculate the fixed, or how you will prepare a budget for fixed manufacturing overhead and variable manufacturing overhead? Fixed manufacturing overhead is very straightforward. Whatever you produce, this is your fixed manufacturing overhead, you can take it directly. But the variable manufacturing overhead, normally you have to set a standard rate or standard rate for each element and you can multiply that with the expected production volume. Now ending inventory budget. What is your ending inventory budget? Ending inventory budget determine the expected value of inventory remain at the end of budget period. There are two types of ending inventory budget, the direct material inventory and finished goods inventory. So these inventory balances are become important input for both budgeted balance sheet and cost of goods sold calculation. So based on your ending inventory budget, this have an impact in your balance sheet and cost of goods sold calculations. Now let's move to cost of goods sold budget. What is cost of goods sold? Cost of goods sold is prepared after all production related budget have been completed. What is cost of goods sold? It estimates the cost associated with the product expected to be sold during a period. So it is a cost related associated to a group of products, that products are expected to sold during a particular period. So how you will calculate the cost of goods manufactured? Your goods available for sales minus ending inventory of finished product. No, the first one, cost of goods manufactured plus how you will calculate the cost of goods sold? Cost of goods sold, it is start with the cost of goods manufactured minus ending finished product inventory plus so how you will calculate your cost of goods sold? Cost of goods sold start with the cost of goods manufactured, plus your opening stock minus ending inventory. This is your formula for cost of goods sold. Again, cost of goods sold budget is a critical component of budgeted income statement because it is directly impact the projected gross profit and net income. So, before winding up this discussion, we will just go through the important point to remember. The first one is what is budgeting. It's an ongoing management process, not a single once a year activity. It's an ongoing process. So, the budgeting cycles include planning, performance measurement, various analysis and continuous improvement. These are the 4 activities included in the budgeting cycle, which start with the planning, performance measurement, various analysis and continuous improvement. Then the role of top management in the budgeting, they have a serious role to setting the long term budget or long term plan and communicate that objectives throughout the organization. Then the participative budgeting. What is participative budgeting? Participating the lower level management as well in the budget preparation process, which improve the commitment, motivation and budget accuracy. Then what is master budget? It consists both operating budget and financial budget. Then the sales budget is always prepare the budget first. This is the budget has to be prepared in the first or beginning of the budget preparation process. All other budgets like your production budget, cost of goods sold budget, purchase budget, warehousing budget and other operating expense and plus the financial budget are based on the budgeted sales. Then the all operating budget ultimately support the budgeted income statement like your sales budget, purchase budget, operating expense budget, all ultimately supporting your budgeted income statement. Then the capital expenditure budget which affect the income statement, balance sheet and cash flow statement. Then the production requirement is dependent on the sales forecast plus your inventory objectives. Once you are coming into production budget, your production requirement or production volume should be based on your expected sales volume plus desired ending inventory level. Then the production budget drives your material budget, labor budget and other overhead budget. Based on your production budget, you can plan your direct material, labor and overhead. Then what is direct material? Direct material budget used to calculate the material required for a particular production budget. Then the direct material purchase budget adjusts your production requirement plus your ending inventory or inventory requirements. If you have to keep more material, raw material in the inventory, you have to purchase more material as well. Then the direct labor budget estimate direct labor and labor cost. Direct labor budget estimate your total direct labor hours plus your direct labor cost. Then the ending inventory budget for direct material and finished product will have a big impact in your balance sheet, and which is desiring or which determines your expected ending inventory, both raw material and finished product. Then the cost of goods sold budget, which combine inventory and production information. Cost of goods sold start with your production cost of goods manufactured plus your beginning inventory minus your ending inventory of finished product. And all supporting schedules are interconnected, like your sales, production budget, purchase budget, all these are interrelated. Changes in the one budget, suppose if you change your sales budget, which will have a big impact in all your budgeting schedules. Then monthly and quarterly budgeting improve performance monitoring. Then accurate budgeting improve planning, coordination, control and decision making effectiveness. If you have very well accurate budgeting process or budgeting, which will help you to improve your planning, coordination, control and decision making effectiveness. So friends, this is about today's discussion. If you have any doubt or you need any clarification on any of these topics, please ask me on the comment section. Thank you for watching this video.